Good morning, everybody. This is 12/30/2014, our last session together of the December Trading Challenge. My name is Bo Yoder. Roger Corey is the other voice you'll be hearing on the line. And thanks for being here. I hope you guys had a great holidays and are getting ready for an interesting New Year's. Coming up real fast here. Not really sure what we're going to get out of today's session. We've got some economic numbers at 10, which may have an impact. I think the biggest story right now of interest to me in the financial world is the shock open of gold. Gold's going to open up pretty dramatically today, and there's a lot of evidence that leads me to believe that is the unwinding of a pair trade which has been going on for a while, where people were going long the yen and the Nikkei stock index to try to take advantage of the price appreciation from the crazy levels of quantitative easing that the so-called Abenomics wave that's been happening in Japan, and at the same time hedging that with a short exposure in gold. It's been one of the reasons why gold's been sort of artificially depressed and sort of hanging in a low range for some period of time, for those of you who've followed that market. Looks like that may actually release, which will give us a higher low, higher high on the deeper time frame charts, probably bringing some investment type buying, and could really unwind that pair trade. So what's interesting about pair trades is it's kind of like a game of musical chairs. The perfect pair trade would be something like, let's say, let's make up two currencies. Let's say that we've got the dollar on one hand, where we have 10% interest rates in the U.S., and we've got Bulgaria, which has 15% interest rates. Okay, there's an interest rate disparity. Remember we talked about Russia jumping its interest rate dramatically to attract money into the ruble after the ruble collapse earlier this month. All right, so if you've got one market where you can basically buy or sell money at 10%, when you are long that economy, long that currency contract, you get those interest payments. All right, so you're a receiver. If you're short a currency, you actually owe those interest payments. Okay, so essentially you'd have a pair trade there. You could go long the 10%, long the 15% and short the 10%, and you could have a quote-unquote riskless 5% yield. That's the promise of the pair trade. Of course, the reality is that you're dealing with these markets in the real world, and there are liquidity concerns. So what tends to happen is when these almost sort of seemingly arbitrage trades show up, people jump on them with many billions of dollars, tens or hundreds of billions of dollars, because the perceived risk is so low. Problem is, just the same way that created we created a crash with the housing crisis in 2007, 2008. The same thing happens in any market where you get too overloaded. When you have a trade that's too good to be true, everybody will borrow money to put into that trade. So the leverage gets inappropriately large and tends to overwhelm those markets. You can see how the precious metals have been depressed in spite of a lot of fundamental reasons for them to be potentially rising and so forth. Obviously the quantitative easing is something we've been looking at in Japan. So the thing about those trades that I detest is the edge is very small. Yes, the return is essentially quote-unquote guaranteed, but what will tend to happen is it's the kind of trade where you make money every week or every month, whatever your reporting period is, for 5 or 6 years, and then you lose 60 or 70% of your profits in some giant short squeeze or unwinding spike as everyone heads for the exits. So those kinds of highly leveraged pair trades tend to be a game of musical chairs. And to me, the risk-to-reward ratio is pretty awful. You basically have to have the smarts to be in the trade before the music ends if you're going to actually capture and maintain those profits, which are kind of minimal for the amount of money that you invested. So that may be an external force that comes into the market, kind of sloshes through the stock market as that liquidity is released and that money needs a new home, which may give us a little bit of an upward pressure on prices. So that's kind of the news of the morning that seemed to jump into my eye. That actually synchronizes with some of the power readings that we've seen. Looks like we're seeing a very minor exhaustion here. We may get a little bit of a ping-pong effect before moving lower in deeper time frames. So not sure if we're going to get some stabilization early on, or whether that's something that's going to kick in the afternoon. But I would expect to see some volatility out of open here, probably to the downside and then whipping back to the upside. Anything you'd like to add to that, Roger?
All right, let's take a look at the charts here. I think, given that it's the last week of December, New Year's Eve is tomorrow, and since what we saw last week was just a market that was very dead, it was all.
Open up the daily, by the way,
Yeah.
just while we're chatting here, so people can see what the month of December has looked like from a daily volatility standpoint. So
Yeah.
very quiet, very much a drifting market.
Yeah, look at that.
Yeah, open that up a little bit so we can see. So really the last, 6, 7, 8 sessions have been very narrow, very drifty, and just sort of hovering near the highs here without really forming much of a sustained breakout. It broke out just enough to be a technical break, but there really hasn't been a secondary wave of buying. So we're kind of hovering here.
Yeah, and actually you have a little bit of an air pocket here that's likely to get filled between here and here. And midway through, usually 50% of something in the market will turn into a level of support or resistance. So there's an area there that can easily get filled. Going up from here is less likely. We're more likely to come down first, and then we'll see where the market sits at that point in time. But for the short term, for today's purposes, we can see that we have a lot of energy, a lot of power to the downside. There's that air pocket. You can see that more clearly on the 135. Okay.
Look how steady that power has been. Just grinding, but steady to the downside, even though prices have broken out to minor new highs.
Yeah.
It's
Okay.
a very contraindication.
And now we're actually, where are we? We're just under the 50 SMA. Now we have a little bit of room to bump up potentially this morning up into this level here. Okay.
So mid to low 80s.
Yeah. So we'll see that a bit more clearly on the 45. There it is. Oh, well, how convenient is that? Look where that takes us. It takes us to the 50 SMA. Yeah. So it's a very easy area for the market to pop and kind of ping pong between. But you see the overwhelming weight of the market is pushing to the downside. Okay? Now, I think today we should have a little bit of fun. We've primarily because of the holiday month and the lack of liquidity, as we saw last week. It's slow. It's boring. Anything that sets up has a very high likelihood of not following through. If you notice, we didn't presume that upon the market on any trading day. We come in knowing that that's a likelihood, but we kind of let the market lead us and let us know, yep, absolutely, it's pretty much not worth being involved in. You can afford to do that when you have a clear understanding of what your risk parameters are and what your tolerance is and what you're willing to work with. So, and then of course following through, seeing that through and executing that on that properly. So, clearly this is a market that could set up and really not do anything, and I'm not sure it's worth our capital resources to be in there. So what we'll do is, rather than waiting in a slow and boring manner, waiting for some kind of a setup, let's discuss where the market's at, and I'll give you a little bit of a treat today and have some fun with the market. So I'll tell you how we're going to do that in a moment. For now, let's do our analysis. So the market looks like it wants to come and push lower, all right, but it looks like there's room for it to push higher in the short term to exhaust itself, to exhaust the little bull cycle right now that is occurring. Again, at the 15-minute chart, we could see that that's an area that could hover between where price is at now, and that could be the top tick potentially. We'll figure that out in a second. But there is room for it to pop higher and get stuck either at the 50, at this yellow PP, the pivot point, or as much as the 200 SMA up here. So let's mark that a bit more clearly. There we go. That's a bit more accurate. Okay? And then here in terms of that, we're pretty much right there. All right. So that's the air pocket. And so the market can get choked up as early as here. This could be the point. In fact, we've got that little dotted dark red burgundy color there. So this is about the area where it can get choked up, or somewhere up here. Okay? For short-term move. Unless something dynamically shifts so we can see power shifting, that's about the area where it's going to get exhausted if it doesn't get exhausted right here. Okay? Let's get down to the 5. Oops. Minimize that, didn't I? How did I do that? Okay. Come on back. Is that? No. Where are you? There you are. Okay. So right now we've got some energy holding us steady above the 50 here. So that looks like it's working its way up to retest those highs. Now, interesting though, if you look back, look left, that takes us to this very clear level of support, which then turns into resistance on the way back up. Okay, and then we have this area right here. And conveniently, what does that do? That becomes a pool of liquidity. That becomes an area in the market. Look at how that lines up perfectly with that pivot point to the high there. So there's room for that to occur. We'll be watching that. Okay. And once that occurs, then the market might be ready to begin working its way back down, and it will have exhausted the bull cycle. Now, how are we going to have fun today? Why don't we take and shift everything down so that we can work in the smallest time frames possible. So let's start with, let's make this 11-second chart, make it a 1-second chart. So let's see here. Oops, I guess it's, okay. That's loading, needs a bit to load. And we'll take the 33-second, make it a 3-second chart. Let it load for a second, so we're not overloading this. So you've watched all month long how we were able to forecast the market, assess the odds, assess risk reward. You've watched how, with a clear understanding and the confidence of the information that your instrumentation panel gives you that says, hey, this is too high risk, this is low probability, this is high quality, we can identify setups. Clearly, we identified setups that we were willing to pass on, that we forecasted where they were going to go. You watched that. You saw
and
how...
actually, that highlights a bad month. This was a terrible month. So the majority of our correct predictions were failed trades that we avoided and didn't take a loss on. We were really never down, I think, on our capital from the baseline ever. Whatever losses we had were from from profits that had been realized already in the month of December.
Correct. So, and then the trades that we were forecasting, each setup was its own, had to stand on its own merit, and we were able to forecast where it's going to go and whether we wanted to participate in it or not. You watched how the fall through of that. Some went through, some didn't, and you watched how neither of the outcomes ever affected or impacted our behavior moving forward. Didn't change or shift the way we interacted with the market, which is an important aspect when you come in and engage with trading. You never want to see something occur and then have that affect and impact your behavior moving forward. Now, the way you do that, though, is by maintaining a level of consistency and control over the output of information you're getting based on the reliability of the information. So that, in a month, may be hard to take and have enough sample size to go on faith moving forward. It may take a little more to realize how reliable and how consistent that information is, so that as you move forward, you know that when it says, hey, don't take this trade, and you forecast properly, correctly, that it's going to go to a certain target, and it does, and you miss that move, that you don't get upset and then go and take a similar trade next time, right? Because you will see that over time, the law of averages kicks in, and what ends up occurring is actually that the vast majority of the time those types of setups don't work out. And so you learn to trust the indications the market gives you and disregard what the outcomes actually display. Does that make sense? First, is everybody understanding what that key concept, by the way? Because that's probably one of the most difficult aspects of this.
That's also brings back a key point about not getting involved in looking at moves and judging yourself based on what moves occurred during the month or what have you. Our goal, we're not trend traders. We're not following the trend and trying to capture the trend. So we're not grading ourselves on how much of the trend we captured. Instead, our goal is consistency and lack of drawdowns. Actually, lack of drawdowns first and then consistency. We want to first do no harm to our capital. Then second, we want to grow that capital very smoothly and very steadily, because, as you know, really the backbone of everything we do is not so much 3D Apex. It's the power of leveraging the compound effect that 3D Apex offers. The accuracy and the consistency allows you to do that at maximal efficiency. So that's always our goal, is slow and steady. We want to be on an escalator just grinding our equity curve higher. And in a bad month, it'll grind slowly. In a great month, it'll grind faster. But as long as it goes in that same direction, that is our primary function. And that's how we grade ourselves.
And understand that the actual engagement of the market isn't based on trading psychology, though on the surface it may seem like, we've got good self-control, good discipline. That really comes as a result of having information, having data that has proven itself consistently over time reliable, dependable, actionable. So that when we see a setup that looks beautiful and that anybody in the world would want to take based on traditional strategic setups, metrics, analysis, whatever qualifies that price pattern or strategic entry, we have a way to measure whether the odds are high that it's going to work out, or that it's low that it's going to work out. Does that mean it won't work out? No, it doesn't. It means it can still work out, but the odds of it working out if they're low is not worth our risk, right? It's not worth going in and finding out the hard way. And see, that is a very important concept that is the cornerstone to what makes this effective consistently for anyone who implements it. Now, I want you to understand our main purpose, our main motivation and driver this month was really to display the fact that you can forecast and predict the market, number one. Number two, how we can actually derive odds from it, and which dictate whether we take trades or not. And number three, to be able to see how that will provide a level of outcome that still is going to produce when you compare it to the world's funds. Okay, you got to think about that, because everyone really measures, most people measure how something does based on the benchmark of the index, as well as comparing what funds in the world are producing and compared to that index. So let's talk about that actually for a second, because I think that's an important aspect here. So let me open up a window here. And bring that, I'm on my second monitor. There we go. And let's go to Yahoo Finance, all right? I'm going to do our stock screening here. So remember last week we went through this. No, not stock screen. We want the fund screen. Here it is. All right. So if you remember, we talked about how many funds are there in the world. First of all, let's figure out how many funds there are that have a manager that's been doing this for more than 5 years. You want somebody who's experienced, okay? So let's go click and see how many funds there are there. Oh, we're going to get, this is, I don't know what's going on with Yahoo lately. There we go. All right, so we have over 25,000 funds, all right? So now let's come back there. There's 20, and by the way, here it is up here, if you're curious where that's at, all right? That's all the funds in the world, and that includes any fund, U.S., international, bond funds, it doesn't matter. You got all this. You can come to Yahoo Finance and look at the fund screen and check this out yourself. Everything under the sun is over here, okay? Now, if we want to look at annual, we want consistency. So let's look at a 5-year annualized return. We want a fund that is able to produce a meaningful return fairly consistently, and that would be, I think, 20% or more per year. Okay, and we're looking at this over 5 years.
It's basically showing they have a real edge, and it's not an energy sector short fund, which happens to be getting outsized gains because of the oil shock that we're looking at, or something like that. You're trying to filter out lucky performances and go to systemically controlled and repeatable performances.
And that's by the way, you have to realize that there's a lot of times where you might have friends who do this. Oh man, yeah, I've doubled my account. I've done this, I've done that. But okay, how consistent, how sustainable is that? Is that something? So you want to see that performance repeated, duplicated, which is what really prompted us to do this now together in the manner that we've chosen, where we've done it in the worst month of the year. We've really challenged ourselves by cutting off the ability to perform as well as we could by having a limited time, both in days as well as restricting the time of during our trading day, limiting ourselves to the symbol, right? Only one symbol, so we're stuck with whatever it gives us or doesn't give us. All those things are kind of hampering down our ability to perform, to cherry pick nice trades. So all of that information we want to use because we want to look at what happens when you institute a process, because the whole month of December is about showing you and displaying to you a process, right, that can be tracked, that can be traced or tracked, right, and compared to what else is being done out there in the world. So let's look at this. So up more than 20%. We want consistency, right? So, and in sharing that with you, now we're going in our 4th year. We're excited that we've been able to duplicate our success through our clients. Every single one of our clients who's been applying the methodology properly, it produces consistent returns. So again, there's that show of data, that there's a repeatability, it's duplicatable, right? It's consistent.
And in the last couple of years, we've seen a lot of different market types and styles. The market's been very dynamic, so it's not like if this was an edge, which I call a cute edge, that works in one small particular niche scenario, that would have been disproven long ago.
And not to mention, Bo, the wide diversity in the clientele base in terms of their experience, their backgrounds, and personality, their personal preferences, their styles, conservative, aggressive. The results are fairly consistent across the board, regardless of what variable we seem to throw at 3D Apex Predictive Failure technology. So that's an important marker as well. So what is all this going to prove to us today? Well, let's look at the top funds here, the ones who charge the most. Obviously, they charge the most because they believe they're worth it. So we want some real experience, and so we want to work with the best of the best who produce the best. And I think that's about it for now, right? I don't think we need to look at anything else. So those are good variables. Up more than 20%, experienced, highest quality, best firms, top firms up there who are going to basically give you the highest quality experience. Let's click on that and see how many funds come out. Out of that, 42 funds out of over 25,000 funds perform over 20% fairly routinely. Now, what's 20%? Okay, let me show you. Let's just might as well do this on the screen. We could do the math in our heads, but let's go ahead and just Pull out the calculator. So 20%, if you divide that by 12 months, that's an average of 1.6% per month. That's the level of performance, okay? The month of December, if you remember last week, we wrapped up our month and all of our trading with 2%. Between everything that we've done, we wrapped up the month of December with 2% up, with all of the factors, the variables that we had that we worked with this month. And we did this live in front of you. Okay, we never did anything outside of our time together, so everything was very transparent. And we took those trades on our live money account. And so that should tell you something. The whole point of doing this is to show you that when you compare your ability to do what professional funds are doing, in fact, it's not just what professional funds are doing. This is the 42, by the way, just think about this, 42 funds out of over 25,000, that's less than 2/10 of 1%. So when you can perform in the top 2/10 of 1% of all funds in the world, in the worst month with all the hamperings that we had to work with, you've got something that's worthwhile. Okay? So let's see. We've got this thing still loading now. Okay, so let's take the next chart here, 9 seconds. We'll put that up there. $27. That's getting faster with each one. That's good.
Excuse our voices, we're both getting over a little cold here.
Okay. So I'm scaling up in seconds.
So what he's doing is rebuilding the lens that you've seen us use throughout this entire experience, and it's just taking it down to a microcrystalline level. We talk about the crystalline nature of markets and the crystallized moments. Now we're looking at moments that are going to be happening literally moment by moment, getting into the microstructure in a way that most people don't even really know exists or care to analyze.
Okay, so now let's see where we are. Let's make that 50 days. I may take some time to load. Let's see how far. It's a little better. Just a amount of data. What about that one? Okay. So this is looking to me like we're still working our way back up here. Okay, so what we're going to do today is we're going to just have some fun predicting the market short term, bar by bar, swing to swing. Okay, so this looks to me right now at this point that we're moving up, okay, and likely to come up and retest this high or possibly go higher. Let's see how likely that is when we continue our analysis forward. Okay, that's working through. Okay, that's working. That's working through. Okay, so it's going through a little bit of a sideways market. Let's see what's underneath that. Okay, currently we've got a little bit of a bear cycle happening right now. Let's see if that's, is there news right now?
There was news at 10, yes. The, shoot, what was it? Durable goods, I think. No,
Did you notice?
Consumer confidence.
It's interesting. Just by seeing the bar and the action, you notice how my mind immediately clicked to there's got to be something forcing that. So getting familiar also with the behavior of the market, understanding what tends to trigger certain types of behaviors is something that comes also as you understand how to read the expressions. These are very visual expressions, just very much like looking at someone's face and seeing whether they're happy or sad, whether they have a kind of a look of deception or a look of innocence, and that really tends to prompt how you engage and interact with that person moving forward. So we're doing the same thing with the market here. This is visual behavioral analysis. Has this loaded? Oh, it's loaded. Okay. All right. So that's steadily moving down. Let's see here. We can expand the data on that. Let's do. We'll do 50 on this one as well. Now, when you're able to trade during just a regular period without the hamperings, and you have the opportunity of looking at all the different markets, you're going to be able to perform, easily 2, 3, 4, 5 times better than what we're able to do without any of those things kind of holding you back. See, so that you could call that a little bit of an artificial performance, and with an artificial performance to come in to that level where you can compete against the top funds in the world is really a bold statement. Okay, and don't underestimate the what happens when you're performing when someone's looking over your shoulder. Those are also, if you watched how there were some times in which some of the distractions were teaching rather than trading, the pressure to have something going in to show you something. Those things all impact our actions. We're human at the end of the day, and so when you take all of that into account, I'm hoping that you are seeing all the things that can really have a negative impact, that really ought to produce a negative experience, and when it doesn't, that you can still have a positive month, and it should display to you the robustness and the forgiving nature of the methodology. So there's a little bit of a twofold, two-pronged agenda here. For those who like to do it yourself, to trade, I want you to see the robustness of this. On the other hand, for those who are looking at management, at research services, at engaging us on a higher level, if you're a sophisticated investor or family office or institution, I want you to be able to see what is possible here for that when you entrust your objectives to a technology that is inherently focused on safeguarding what you have to begin with and then keeping what you earn as you move forward. Totally different shift in focus here. Okay, so we've tapped that area. The numbers came out. The market's reacted and seems to be working through that level here. So let's see what we are dealing with. Still kind of weak. Any questions so far? Okay, so this is very bearishly inclined, but really stuck at this level. So you can see how we have a little area here. Excuse me. That's that ping-pong effect that we're experiencing right now. So that's bouncing between the 100 and the 50. All right. All right, so that is in the middle there. Now look at this as we start to drill down deeper. Visually, you can begin to see the barriers that need to be crossed. We have the 10 SMA, all right, and we've got the structural area here. It's going to break. It's got to break through that in order to have any real reason to continue higher. If this gets held by the 10, even the 20, or excuse me, 200 rather, there's potential for that secondary area. Needs to be able to break through that. It looks like it may, but we're waiting now. And we, of course, we said, oh, we got to plug in here. Okay. Let's go look at where we are here. You've got this area here, which is that 100 SMA. So this is kind of the area where we have to find resolve in the market. So we'll see what happens as we let that play out. We'll come over to the next time frame. Okay, that's not looking like it's ready to go down, and that's why you're seeing all that rejection. Okay, so you see how you got the tail. So this is still very much in a bullish state, right? Though it has bearish tendencies. So we'll still maintain that posture of the market needs to cycle up before continuing to cycle down. Okay, this is, and remember that was the bigger time frame from this one. This one looks very bearish, but it seems to be potentially peaking out to the bottom. Let's see if that's true here. Okay, so that's looking like it's beginning to peak out in terms of the downside. So that looks like the cycle low of that bearish move to the downside, and we're going to begin the exhaustive churning here at this level, and then I think we're going to see a move back up. So let's see. Yep, here it is. That shift is more clear here. All right, so at this point, we're going to see a move easily up to this level here. I know you're going to see a bunch of drawings, but if you're watching me layer by layer, we should be fine. You shouldn't be too overwhelmed. Notice how now price is sitting and being held by the moving averages right there. All right. So let's just watch that pan out. So you see that little air pocket. This is what we call an air pocket between here and here on the 27-second chart. Okay, and that looks like an area that has a high probability of filling. Okay, now does that mean that it's the reward is worth the risk? No. In this case, there's not enough, right? So in a normal sense, normal trading environment, you'd need to see easily much more. You need to make room for your stop loss, your entry. You need to give yourself a buffer there, and you need to know that you have a very high probability of getting a 1-to-1, so you can at least break even on that trade and remove your risk by taking off half your position. always focused on risk. Okay, you're watching the market now fill that. So you're watching us now essentially forecast bar by bar, swing to swing, and predict the market forward. Okay, when you look at the lower time frame, you start to see the exhaustion. Look at that. Can you see how from here to here, think of it like a vehicle with fuel. You see how it's running out of fuel? So you're seeing that there's a high probability of that being a short-term top that requires the market to come back into these lows and then maybe reload, refuel up, and then come back up. But as it's coming back up, it's going to come back up potentially on less power. So it's losing its ability to maintain the move up with each swing. Okay. Let's go look and see where that is likely to take us. Okay, there's still plenty of power to the upside here. That's holding fairly steady. It's fairly consistent. So that tells us that that one chart just above that was sandwiched between two opposite bias charts. That's still indicating more room for this to go to the upside and continue to fill that space with probably right now with where it's at, probably about a 65-70% chance. Okay, so we'll wait and watch the fall through of that. Now I can't sit there and go into a whole lesson mode and teach you how to derive exactly the odds. That's beyond the scope of our session here. But I want to show you the effects of implementing predictive failure, which on the opposite side there, if you're predicting failure, you're predicting success. In other words, either way, you're forecasting the market ahead of its move. Okay, so you see how it's steadily working, pushing up. And there it is. We beat that high. Look at where we are. Here's the top. Okay. Let's see where we are here. See the whole lens. Still holding pretty steady. So it looks like it still has room to continually move towards exhausting the cycle, the bull cycle to the upside. Still working through that. It's now price is being held on the 27-second chart, our middle chart here, by the 50. It's closed above with plenty of energy to the upside. Power and energy is flipped on the 81-second chart. Okay, and there's more room. Look at this. See that? There's still more room up to the 50 SMA. So we still have that little air pocket to fill. You can see that ellipse that I drew earlier. Now what's happening here? It's getting stuck. Okay, it's getting stuck on the 20 SMA, the blue line. So it's naturally going to react to that. Okay, but it looks like it's likely going to break through that at this point. So there's a good, I'd say about 70% chance of that thing popping right up and filling this little hole here between the 20 and the 50. There it is. We just got it. Boom. Just clicked. All right. So you see how when you contrast, there's two things going on. On one hand, you're able to forecast the market, but on the other hand, that doesn't mean that you can be involved in the market every time just because you can forecast it. You see, there's a wisdom here to the process. So on the outside, on the surface, one might say, well, if you can predict the market, you should be a multi-gazillionaire. Okay, that's not how it works, right? Because though we can forecast the market, we also have to forecast, right, the probability, which is part of that, and you're seeing me assess that. And if it's not an 80-90% probability, I really don't want to be involved. Less is more. We're looking for high quality. High quality means low stress. High quality, high probability means what? Consistency, stability, less uncertainty, more confidence, an enjoyable experience, a fun experience. How many of you have ever played a game, whether it's a board game, a video game, or any kind of a game, in which you really struggled to kind of just even keep up with it, right? It wasn't any fun. You gave up. You're like, I'm not enjoying this. It's too complicated. You got frustrated and you walked away. Versus the games that you seem to go, you made some progress and you beat a level or two, and you were able to see something come out of that that was rewarding. You started to beat a couple levels, or you're scoring points. That encourages and motivates more. It gets you excited, and so you have some fun. That game turns into a fun game for you. So the challenge doesn't bother you. It seems like it's something that you can handle, and you're motivated to continue with it. So you want trading and your experience in the markets to be very much the same. You want to have a fun, enjoyable experience. You don't want it to stress you out. And you're fully in control of that once you have tools that give you a very confident read on what the market is doing and what it's likely to do and what are the odds of it doing so that you can at any point in time know whether it's worth your time, whether it's worth your resources, right? And sure, it can be boring most of the time because you're not engaged, but you also don't have to sit here and stare at this thing forever, because you've watched us also remind you throughout that, look, if we weren't doing this live with you, we wouldn't be here watching this. We'd go off and do something else. We'd come back in a little bit and check on it again. You could even put a price alert that if it hits a thing, it'll text you or alert you so that you know when to come back if it happens to do it sooner. Or maybe you don't want to come back and engage the market at all until it hits a particular level, and so it might take later and more time, and so you just give it that room to breathe and you go on and do something else. You don't have to sit here. You can manage your time efficiently, effectively. You could read. You could multitask. Bo plays online poker tournaments. Whatever. It doesn't matter. So understand that this gives you a very powerful edge and a powerful ability to control your time and control your resources confidently in a way that you never thought was possible. Okay? And I hope that's been clearly displayed for you this month of December. Look what's happening. It had to digest this area. It had to come into the apex of the 20 and the 10. Look at how those arbitrary lines are actually have some kind of an effect on price. They're there. This is called market geometry. This is called the order underneath the seeming chaos in the market. It still looks like it wants to fill that gap to the upside.
We talked a lot in this month about liquidity and analyzing liquidity. And really, if you think about it, the crystalline moment, the reversal, the moment that you saw us do a couple of times where we have a series of no's getting our way to yes, that's really all about finding liquidity inversions. And if you look at this little chart that Roger's got up, actually, Roger, if you highlight 622 to 641, we have a little bit of a move up there. And as I've said in the past, there are four ways a market can move. In the beginning here, we saw a market that was pretty clearly more buyers than sellers because you have a lot of overlap. So that was a very positive move to the upside. Then the market really found equilibrium. We had about as many buyers as sellers. You get a lot of overlap and a lot of back and forth. And then you see how there was a little break to the upside, that little doji there. Yeah, exactly, right there. Final little breakout, which was the ultimate high in that move. Okay, that's a wave of liquidity. And that liquidity exhausted itself at that point, and we experienced a liquidity inversion, and then the market went in the other direction. So what does that mean? All right, let's say, I can't think of a great analogy off the top of my head, but let's say there's an obvious reason that everybody should be buying at that point, and everybody knows they should be buying, and there's just a lot of visibility about the market's need to go to the upside. Let's say it's an economic news or something like that. All right, so at the end of that move, everybody's bought who wants to buy, and the stimulus is over, okay? So at this point, you've got a market that's moved up. It's sort of lost its energy at the end of the move, but it hasn't fully completed the liquidity cycle yet. And the way it will end its liquidity cycle is when the last person who is responding to that stimulus gets filled. So usually the more sophisticated traders get filled in the beginning, and the least sophisticated get filled at the end. You've got this moment in time where the final person buys at the high tick. At that point, there's really nobody left to buy in that tiny little moment in time, and that's liquidity exhaustion, liquidity inversion. And the market flips, and you get a good push in the opposite direction. That is the fundamental structure behind the success that you've seen us have really in every one of our trades. Even the ones that failed that we predicted failure on and scratched out of. The liquidity cycle came to an end. There was a liquidity inversion. If that happened in an area that we wanted it to occur, that's where we would take our profits. If it happened as a surprise in the middle of a move, that's where we took our scratch.
So what's important about that is that at every point, the market is proving to you and leading you towards your next decision point. It's always been a very confident, very certain interaction in which you're making a decision based on very clear data points. So you're not guessing at what is likely to occur. You know what's likely to occur. And sometimes the market will, because the market's, by the way, are you noticing what's happening? How it's filling that air pocket? There it is. So it reacted to the 20, came back, ping-ponged. How many times you've heard me say it's going to ping-pong between here? It went to the apex, finally exhausted that impact of resistance by the 20 SMA, and it was willing to break through, and now popped right back up. Now it's dealing with the 50. Look at that. And it actually seems to have a very easy time breaking the 50 in this regard. It's built quite a bit of power to the upside, and you can see how that power shift is part of the reason why it was so easily broken, that 50 SMA. So throughout each decision point, the market may give you very clear indications at one point, but something dynamically, some external force can come into the market, or in this time, in this month, when we have a lack of liquidity, it takes very little for the market to either not follow through or to make a big splash and have a huge, weird whipsawish type move because of the shallow level of volume, right? So when you have a low volume or low body of water, a shallow body of water, it tends to make a big splash if you throw something into it, right? If you have a larger body of volume, like a big lake, you're not going to see a big splash. You'll see a little bit of a splash, and the ripples are going to be contained within a little bit of an area there, but then they're not likely to continue rippling through all the way to the edges of a big lake. So, so what we're doing is, at each point, we know confidently, and that's why you never have to sit there and expand your risk envelope beyond what your parameters should be set at. So once you know where your parameters are at, sometimes you might make a little bit of a human error, and oops, you miss a support or resistance level when you open up a chart and you go, oh shoot, I missed that. That happens, but that's radically different than guessing, going, oh, maybe I should give it more room to breathe. Oh, maybe I should give it. Let me let it go even further, because it's got to turn around. I know it's going to turn around at some point here. It can't possibly go too much higher, too much lower, and so that whole thing there is you kind of figuring out how long you should stay in versus knowing what the limits are, where the boundaries are, where you should say, no, something is off, something shifted. I shouldn't be involved in. I should not participate with this market action, and you close out. And it's better to do that. As you've seen here, we've had a wonderful month in terms of teaching, because you've gotten to see all the things that most people endure and experience in the market on their own, which stresses them out and causes them heartache and confusion. So when you can see that the market has shifted and it's no longer worth holding on to, you pull out with a little bit of a scratch loss, like a 0.5% or 1% or whatever it is. Guess what? That's better than a full 2% stop loss, or several times better than having that 2% stop loss under 4%, 6%, 8%, 10% or more, right? By holding on to drawdowns and just letting that thing just erode and waste your time and paralyze your capital from being able to be used more profitably somewhere else. Those are things that really take away from you. They rob you from opportunity. They rob you from growth, and they dig a hole that you always have to fill back up before you're back to even again, before you can build beyond. Okay, and that's really a principle that is often overlooked in anything in life. You really want to stay where you're at and build from where you're at and continually grow. You don't want to have to create a hole that you have to fill back up because the energy and the effort and the time is just wasted, right? That could have been productive. All right, so we're seeing the market kind of whipsaw flip back and forth here. Let's see what else we can derive from where this market's at. Okay, so now, now the market seems to have exhausted itself potentially from on the upside, and looks like it's potentially going to begin working itself back down. So let's see. Let's come back here and see where we are. That's holding steady. We have filled the initial air pocket there. It's struggling. Excuse me. Still struggling there. Interesting.
Really what you're seeing is a lot of equilibrium there.
Yeah, exactly.
And there's just not a lot of power or passion to take that market out of this little congestion zone.
So that still has some time that it needs to work through.
So see, all that means is one person might look at that with the glass half empty viewpoint and say, market's terrible, hate this market's awful, grumble, grumble, grumble. We see instead that the market's not terrible, it's just not ready yet, it's not ripe. It'd be like planting seeds in an herb garden to use to cook with, and then being mad when they're not up, 10 days from now.
Yeah.
It takes time for things to ripen so that you get a full expression of the rejection that you want, because you don't want to get in. Imagine if you got in at 20, 70, 750 or so on that last little spike down or reversal. You never got more than maybe a point in profit. Now you're back below your break even, and you're hating the experience of holding throughout all this wiggling and uncertainty. Our goal is to let everyone else take that risk, and then we come sweeping in when the liquidity inverts, so that we have the easiest and most comfortable and confident holding period.
Yeah, if you notice that's we did that over and over again repeatedly throughout the month of December, and then in moments of illiquidity where there was like a fall through, you basically just had a very a shallow experience in the fall through. You could tell that the market, there's an absence of participants there. Very different than having this weird back and forth frustrating experience. So you want to see how the kind of the overall outcome and experience should be one of getting in and things kind of just start to unfold for me, right? You have very little frustration of market action because you're calling. You've watched us call literal turning points, false tops, false bottoms throughout. I'll go through our raw video feeds and I'll summarize the month of December for us. I'll put a little bit of an edited summary video of all the different calls and actions and everything we did, highlighting specifically just the ability to call false tops, bottoms, turning points, the forecastability of the market. Now look at here. What we're doing here, I want you to take note. We're going to retest this area here and potentially go as low as that green line, but we're doing it on a lot less power. So that's likely going to come in, retest. It may reset the market down but it's likely also going to actually set the market to push right back up. We'll have to cross that bridge when we get to it. You see, I'm giving the market room to breathe. I'm taking all the data points. It's clearly not at a completely it's not at a state where it's completely exhausted or at the end of something. So there's still more room to go on either side of this this price action, up or down. We're at kind of an interesting point in the market. So we just let that thing play out. So once again here, yet again, it seems to want to push right back up from where it's at. So if you remember the first one here, oops, let's see this. There we go. There's that first arrow, right? There's the first arrow. We've completed that, right? So we predicted the market up into this zone. We beautifully and perfectly hit that right there. Okay. That market went nicely to that area. So there's that zone. And then that's when we had a bear cycle begin. And that bear cycle now is coming down to retest this area. And it just looks like it's going to consolidate a little bit to work through the liquidity there. See, that's showing signs of exhaustion. Look at that. It's pushing, holding steady, and power is just completely eroding. Okay, so we're beginning our bull cycle now. That the end of the bear cycle is beginning, and the beginning of the bull cycle now is shaping up.
I don't know if you addressed this earlier, Roger, but in terms of when we're looking at the mutual funds, at least from my data, we opened the month in the SPY, so that's the S&P index proxy, at 206.40, and right now that's trading around 207.88. So if you just simply do a quick calculation, so 207.88 minus 206.4 is a spread of $1.48. So if you'd put money in the S&P at the beginning of December, you're up $1.48 in that ETF, which if you divide by 206.40 is a price appreciation of 0.717%. So less than 1%.
Less than how much?
So we've actually doubled. Less than 1%,
okay.
0.717%.
Okay.
So we have actually doubled with our 2%. We've doubled just a passive buy and hold strategy in the S&P. So from the S&P benchmark, we've beaten that at this point.
That's awesome. No, I hadn't actually looked at that number yet, but that's a fantastic contrast also, because what do the funds try to do? The funds try to beat the benchmark, which is the S&P. And S&P is a very common benchmark for performance. So to beat that, again, in the month of December, with all the hamperings there, that's a beautiful display again of the robustness of Put2Fair technology. That's exciting. Okay, so we're wearing that edge, that area, that level of support out. Remember that it can fill to the bottom, excuse me, or hold right here as a choke point, and then it looks like it'll begin its move back up from there. So let's go and see where we are on that. Let's see here. Okay. All right. So this looks like this looks like the potential cycle beginning to go to the upside. Let's see. Still struggling, but it's holding. But this looks like the cycle that will start to push up from here.
And you see the little washout that occurred on the 27-second in the top middle. It actually shows it pretty well. Kind of sat on the top of the little ellipse you drew, and then there was a little exploratory push, and that was kind of the final exhaustion, which turned things. That's the kind of liquidity inversion that I was describing earlier. It just occurred in real time.
Talk about that, Bo.
Yes. Because remember, the liquidity inverts if and when that final market participant gets their order satisfied. So if we're talking in this case about...
Well, you went on mute accidentally.
Am I back now?
You're back.
Okay. When that final market participant, in this case that wishes to sell, does so, that's when the market inverts and you start to get a push in the other direction. Now, how far will that push go is up for grabs, and that's where the power indicator comes in.
Yeah.
Just because you've discovered a high probability reversal point, as we've shown you over and over and over again, doesn't necessarily mean there's a lot of money to be made having done that analysis. That's really where the rubber hits the road. Just being able to predict tops and bottoms is kind of useless if you don't have the ability to then objectively measure and forecast either ahead of time or as we do it in reaction to the power that exists rather than the power that we hope will exist. We can actually look, as you've seen, intra-trade, in the middle of a trade, and know if the trade's going to surprisingly run out of steam or whether it's building steam for a much better outcome.
Okay, so there's a little bit of a hesitancy here. I think we're going to push back down potentially here. We're not quite ready. You can see how, again, remember, are you watching are you noticing the pattern here of behavior? You're noticing the theme? What happened here? Price ran into the 50 SMA. What happened? It reacted against it, right? So these are, again, visual markers to help you understand the inherent underlying order, right, that's in this market. This is market geometry. Look how we're moving lower now, right? Just told you that we're looking like it's going to move lower. It's going to ping pong here. Now we've come back and exhausted again. Look at that. It's going to ping pong back up and retest that 50 area. So, but it's doing so kind of on a little weaker power here. Let's get back to our full lens so we can see everything with clarity. All right, now we're shifting again. Okay, here we go. Now we're ready again. This time it looks like we're more primed to break, to either test the 50 again, and it's looking like it's starting to work towards breaking through the 50 potentially. Let's see what happens here. It'll depend on how the 81-second bar closes. If it can close above the 10 SMA, all right, on the 81-second chart, then we have a pretty good shot. The odds will be higher that the market will break through the 20 SMA. Now, yeah, it's looking like it's going to do that. So now we're going to be back. It looks like this is the area in which the market's going to begin working its way back up from here. "30 seconds left on the 81-second chart. We want to get a real body close, ideally. That's the ideal. It's not necessary, but it's ideal. Okay, so we got a doji, so that's a bar of neutrality. You want to see that, there it is. Okay, well, I was going to say you want to see that hold there or break, and it is now, finally, so that's good. There's the fall through, and there we go. We're beginning to fill that air pocket. Okay, so we've broken now decisively above the 50 SMA on the 27-second chart. You see why I use the second charts? May seem crazy at first, but then what that does, you're realizing now, is if we can forecast and predict on these ridiculously small time frames, what does that mean? That means that the higher time frames where there's more order, there's more volume, there's more stability, are going to be that much more reliable and dependable. The higher in the time frames that you go, the stronger the more likely the follow through, and the stronger the indicators are going to be, because you inherently have that much more money and volume involved and interest.
What's really exciting, though, is when you can find a deep time frame cycle that's coming to an end and then drill down and find your entry in the smallest of time frames. You can end up with some insane risk-to-reward ratios as the result of that precision. So it can be kind of annoying sometimes because the small time frames have lots of false signals and lots of no trades that are filtered out. But if you have the patience, it's worth mining down into the small time frames. You can get some amazing entries that otherwise wouldn't be available.
See, and that's because a turning point is a turning point. If you can see a turning point occur on the 4-hour chart, then as you drill down all the way down to these smaller second charts, potentially, you can grab a ridiculous risk envelopes. In other words, if let's say, for the sake of this example, let's just pretend that on this chart here, you saw that on the 4 and 5 minute chart that was the turning point, and the market was going to be moving higher. So you could see that you could grab a risk reward in which, if that's true, you could grab this entry here. Let's see here.
Never forget that any bar chart is just an arbitrary chunk of an ever-flowing data stream, right? So there's really nothing special about a second chart or a minute chart or an hour chart. Those are purely human, arbitrarily derived chunks. Because without that, we really don't have any way to measure one instance of power against another. So that's why the amount of time that you put within each bucket is really available to you, and allows you to feather up and down to do what we call a lens shift, where you can essentially look for where the order is, where the crystalline moment is likely to be, and then begin to focus on that time frame.
Actually, let me do it differently here. The better example that's going to be more consistent with doing a 4-hour time frame would be this one. So let's just say on the 4-hour chart, and actually, why don't we mark this? Why don't we go ahead and reflect that? Do I have an extra chart that I can use? I don't. Let me pull one up. Notice how the market's coming right back up, like I said. Notice how. So again, we're predicting the market bar by bar, swing to swing, and so if you're noticing that though we can do that on extremely small time frames and on fast-moving time frames, the experience is still very consistent, right? But the main point here is you'll spend more time disqualifying, invalidating a setup than you are validating one, right? Because you're looking for, we're cherry picking the market. Again, part of this isn't just making money, but being consistent, having stability, low stress. Again, it's about enjoying your experience, having fun doing this. All right, so let's, the symbol here is the ES. And we want the 240, which is the 4-hour chart. All right, let's see. Forgot to put the template on there. Whoa. All right, so there it is. Excuse me. Yuck, right? All right. So if that's the top, if you're seeing a top there, likely your risk envelope there is going to be, there's going to be some bar there that you're going to look at if you're going to enter. This box that I just drew is going to be your risk envelope. All right, that's your risk envelope. Well, if that's your risk envelope, just to get a one-to-one, you're going to have to come down here. Okay? So let's hang on to that for a minute. Now, that means see what that means? See where we are there? However, by coming down to the smallest time frames, you might be able to assess that you could take this trade here and let's say it was primed. Let's see, because we've drawn that we have a potential for coming back and retesting these highs here. So we'd have to actually make our marker based on this chart here to make this a true example. It would have to be here earlier in time, because that would be a clear, and I'll tell you why here when I put this over. Okay, so you'll see that we look like we're at a topping point here in the market. So we'll be looking at that area here really, and that, let's put that excuse me, I had to cough. Our trigger there's our trigger. All right, let's go look at the small time frame. Okay, here we go. So that likely would have had to been the area where we would take an entry that's really tight. And based on this, yep, so that would have been here. On a small time frame like this, you look at the upper time frame. If your risk envelope is going to take into account that higher high, you're still getting a better risk reward here by understanding the fractal nature of the market. Okay, because when we look at where that's at, by the time you get your 1-to-1 on the 4-hour time frame, you've gotten almost 2-to-1 on the smaller time frame. So that's basically the point I want to bring across here. Took a little bit of work here just to kind of make an example for you. I apologize, but the point is understanding the fractal nature when you have a turning point in the market. Now the difference here, though, it really starts to compound if you believe that the market's going even lower to fail to come up to these green lines as the target, because then now you're talking about doubling that. So instead of having 3 or 4%, you're going to have anywhere between 6 and 8%. Okay, and that's a big deal. That's huge. All right. All right. So look at that. Here we are. There's the move that we were waiting for. We predicted that move as well. So notice how we basically plucked off the move to the upside, saw the exhaustion, waited for it to come back, retest, saw the exhaustion to the downside, okay, and called the market back up. And all of that is being done on time frames that most people would never even believe are possible to interact with, because they're just too unstable and they're too noisy. I need to get something to drink here. You have to forgive me. I'm struggling this morning. Take a quick break here.
All right, let me jump in while he's regenerating the vocal cords. So now, we also talked a lot about the cascade effect, and you can see how that's beginning to happen here. The reversal on the 27-second has occurred. We've got a power shift. Power is growing. Power is growing through onto the 81-second chart. So you can see how in the smallest time frames you've had kind of a power inertial shift, where you've got power flowing from one time frame to the next. Again, we're looking at something that's intra-range, so from a trading standpoint, you're looking at, 2 points of profit, something like that. Not all that much to get excited about, but again, it's not about the point of what we're doing here is not about the size of a move, it's about the predictability of the move. Now we're starting to reach up into areas of resistance from the deeper time frames. Starting to reach a liquidity inversion moment on the 27-second chart. But we know from our 81-second chart there's still a lot of power there, that this move is not truly over yet. There's going to be more digestion needed. Now, what I want you to watch is how the topping pattern that we're seeing form on the 27-second is going to erode power on the 81-second. Now, the beauty of this is it's going to happen quickly. You're going to be able to see this very easily. whereas a lot of the time frames we've been trading throughout the course of our month together would have taken days to unfold or to change. First, you see the small time frames flipping over, 9 seconds scrolling to the downside. The 27-second just went bearish. It's going to give us a little bit of a sell cycle. And again, the better you can get at seeing things fractally, the more opportunities you'll have. You know, as we get a pullback here towards areas of support on the 27-second, with all the power that's latent on the 81 and the 243, that's probably a decent little long entry. And if this were a deeper time frame chart with more room and more dollar profit potential, that would be a trade worth looking at.
So let's remember when we first started, we talked about this area here. Let me take these boxes are no longer necessary, so I'll take those back off. You can hear me fine, right, Bo? My audio's coming through?
Okay. Yes,
Okay.
coming loud and clear.
So here's the ellipse. So remember we talked about this area? So we're working through that area. We're working towards that right now. Okay? So we knew that we had that to work through. We came up the first time, we thought, well, maybe this will be it. And then when we looked at the upper time frame, if you remember, we saw, no, not quite yet, right? So we needed to continue working through. So now what are we doing? We're running into this level of resistance, which is the 50 SMA. We've hit it once before, and this may be the time it breaks through this time. All right. And actually, look at the difference here. Yeah, there's a slight higher high in the power, even though price is quite a bit lower. So you're seeing a lot more power here than there was previously. This is indicative of a market that is coming with a lot more strength and ready to break through this level of resistance. So we'll be patient and watch how that
Which also lines up with the concept of this being a potential pullback trade on the, what was it, 20-second chart.
Correct. Yeah, exactly. There it is right here. You've got a very, I don't know, sometimes you've got a lot of gray area here. You know, you want to call this a little mini sloppy bull flag or maybe a pennant that's forming, a bull pennant. But now look, actually it looks like it's going to pull back potentially to this area here, to this zone. Excuse me. Man.
We are vocal athletes.
Man.
You're going to be sick as a dog and still do okay, but well, when the voice goes, everything goes.
It's wild. Okay, well, let's see. Is this a short-term push and not likely to hold? Let's see. No, that's building. That's building. Okay. So we're coming into that area here. So there's that's more of an appropriate bull flag that's setting up. It's a bit more, looking like it's going to be a bit more defined. You want that. The more clear you are, the better, stronger it's going to be. Lenger. Okay, so we just hit the bottom of that. There's that area right there. We just hit that. Remember, anytime you draw, when I draw these, the zone begins at the edges, right? It doesn't have to fill that. It just has to touch the edge, and we know that we've met we've come to that boundary. we've hit our first wall of support in this case. Now it could fill, it could go further, but it looks like it's still going. So let's go see where we are. All right, so now if we look at the lower time frame, that helps us understand the cycle here. So there's room for it. So what we have to see now is either a break above the 10 or a push below. It's going to force the 10 is going to force price to come down lower and reach into the 200 SMA before going back up. Anything within the zone of this ellipse will be the zone in which the market is exhausting itself. So now what we could see is a little bit of an inverted head and shoulders, kind of a little lazy formation there. It looks like it's beginning to form right now. So we are likely going to be holding in this pattern here. The head is taking shape now. We're seeing an erosion on the 27. The big bulge theory, for those of you who are clients, this is going to cause price to come back and retest these highs and likely to push price higher. We are exhausting our move. We've got the 27 sandwiched between two opposite bias charts. We're beginning to exhaust. We're coming to the end of something on these lower time frames. That's funny. Longer. Got that comment. That's are you looking at the little funny comments there, Bo?
Yeah. We talk about the market hacking and gasping. Normally we're not talking about ourselves.
Yeah. All right, that's still building actually. So look at that. There was a little bit of a false. See now, immediately we could see that there was a false little setup here. It's built even more power suddenly. There's been a little bit of a dynamic shift. So there, that kind of produces a little questionability. But again, we're looking for a pattern to set up that hasn't set up. We're just looking at developing the head here. The head's not quite done forming. So we're looking at a very clear, decisive shift, and that has not yet occurred. All right, that now looks like it has potentially bottomed out and will be a head, if not, let's see here. No, we've got enough power there, so we should see a shoulder here form.
Now see how cool it is when you can use these tiny time frames for teaching. We're compressing the kind of cycles that would take all morning to unfold in just a couple of minutes here on the 27-second chart. And the validity of the analysis is exactly the same, 100%. The size and the potential for the profit's a little sketchy. So that's the point we're trying to bring here. So again, it's about ripening and developing and watching these things as they build. There's your little lift back up towards the shoulder areas. See if we can get that final push back down to deliver on the promise of what we've been talking about here.
Okay, there's your little prediction. That's your head, inverted head and shoulders. Shoulder. Oops. Head. Pressing the wrong button. Shoulder. Now you could look here, because of the power on the 27-second chart, there's a potential to come back and retest and turn it into a double bottom. But then that's why you would actually, if you were going to take this long and we're on a higher time frame, you would take that into account in your stop loss. There's about a 10% chance that if it came back down, the market could shift its weight and test the pivot point here, which is clearly an area of support that can act like a magnet, and it looks like it might want to. There it is. You see that? There's reasons to understand when you're looking at a setup where nothing's 100%, but you're looking at working with the odds, right? Notice, by the way, incidentally, that the market would have never triggered you in. You never take a market order into the as your entry. Okay, you always let the market follow through. If you remember, throughout the month, we always come in ahead of the market. So look at that. It's even going down to this lower level here. Is there any? By the way, that was interesting. Is there anything that came out right now? Any news?
Not that I know of. There's certainly nothing scheduled. Let me just check the couple of news sites for you real quick.
That was an interesting shift. So we always come in. The price came in. The reversal candlestick was at 79.25. So our entry price would be at 79.5. You're always one tick above the high. Okay, so that would have saved you from being entered. And again, if you've watched us enter and exit, it's always been, our stop loss is always one tick below the low, and our entry is one tick above the high if we're going long, and vice versa if we're going short.
Yeah, I don't see any news. I don't see any news. This must just be normal operations or some news that may come out a little bit later on here.
Okay, so here's that big, see, it's
nothing scheduled.
Look at how uncharacteristic that bar has been. The red bar there. So you see the failure there. That just says we're likely to come back and flush out some of these lows now again. Now the market may shift its weight here. We'll have to see. So you're noticing how there's little techniques throughout the process that act as little buffers or little insurance policies to help safeguard you against instability and dynamic forces that can come in and shift last minute. So we're always looking for a very decisive market that moves with conviction. And we let it prove itself to us. We let it lead us.
And the sad reality is that a convincing market with power and passion and energy and follow-through is pretty rare, especially in recent years. So that means you get a lot of no's on your way to a yes. So just be ready for it and expect it, and actually be thankful for it. It's keeping you away from some negative outcomes that you otherwise would have probably experienced.
Yeah, and a 15-hour commitment to the markets across the board. Our clients will average between 4 to 6, maybe as much as 8 trades in a week. So just imagine, that's not a lot if you think about traditional trading experience with 15 hours. Usually that's, you should be able to get, you know, on small time frames, 3-minute, 5-minute charts, 15-minute charts. And I used to trade multiple times a single day, multiple trades a day. So
when things are hot and active in the ES, you're going to get 1 to 3 trades in a day, whereas we've been seeing probably 1 to 3 in a week in this quiet month of December.
And remember, don't forget, not only is it kind of a quiet month, but it's also a month that lacks liquidity, so that you're going to have higher rates of failure in the setups that occur. So, so in other words, you get setups that fail to really follow through into their intended target because there isn't really enough market participation to follow through and carry forward what's inherently setting up. The liquidity's in there, and you get these weird splashes of price action, you know, because of the shallow market. So you get quite a bit more instability, whipsaw, choppiness, lack of follow through, all that. So December is generally, that and August are going to be nightmare months to trade. It's just a nightmare to trade. And again, what a beautiful display of the robustness and consistency that predictive failure technology and the trading methodology provides, even in these circumstances. And by the way, why is that? As things can shift, as things can ebb and flow, regardless of market condition, you can stay consistent and stable because you're dealing with a principle-based approach. It's based on principles that don't change with time, circumstance, or condition. And that's what makes that robust and reliable. And here now we've taken it on we've looked at different time frames. It's consistent. Some of the other techniques that we institute in terms of getting our actual order entry, the mechanics of that, safeguards us further. So combining the two really provides a real solid 1-2 punch for being able to come in and really have a good, smooth, consistent experience that you can enjoy and put your head on the pillow at night and be at peace and not be worried. Yes, when the market shifts its weight, it's changing its direction, but not necessarily long term. It could be short term. It's just a liquidity push where you have a short term bear cycle that happened. Because remember, we still on the upper time frames can see that the market is digesting and consolidating this area here, this zone, this ping pong that we talked about first thing in the morning. So remember, this is our posture is still the same, right? We talked about this area here. Actually, this area here. There. That needs to be digested. So that's all that's happening. It's just ping pong between these levels of support and resistance. But what we're doing is on the smaller time frames, we're able to actually predict the cycles up and down in between. So we've seen 2 bull cycles we predicted, right? Within a market that is generally bearish, right? But we're working through all of that, and there's a potential for it to come up and exhaust itself to this upper ellipse up here before finally moving down. And when it does that, the market may shift its weight yet again, in which it gets stuck up there, and that may cause it to erode enough of the bearishness that it might push back up. We won't know until we get there, though. We'll cross that bridge when we get it, when we get to it. But right now, as it's indicating, okay, the expectation is that the market is likely to push up, exhaust itself to the upside, and then begin working itself back down into these levels where we've got the green lines. First one here, second one there. And then there's a further move to the downside in the form of the ellipse that we're seeing all the way down here. That's going to be the actual target. Isn't that nice when you know what to expect up front and you just patiently wait for the right opportunities and the right triggers? You're just not sitting there, in turmoil, trying to figure out, oh, now is this the right time? Is that the right time? Should we? Well, what about now? And well, maybe I should do this. Maybe I should do that. And you start to play this game back and forth, trying to negotiate with yourself what you should do. It's never fun, and long term, not really very productive. You may get results, but statistically, you want something that can be repeated reliably, responsibly over and over again. Now you've got a business. Now you've got something you can take to the bank, and that changes everything. So you see that further exhaustion of that area. Now, by the way, look at how we've come down here on almost nothing power. So this seems to be a very exhaustive move here to the downside, and that should help push on the 243-second chart. That may actually be the time. Well, it's still looking like it's still pushing through. We want to see a break above the 50 SMA here. So let's see what happens. It's even more exhausted, actually. So this, look at this. I just noticed that. I wasn't paying attention. Look at that. I'm drawing that arrow right there. Look at the shift here. Now, that's it. So this actually looks like this will be the move that holds us above. This looks like the move that should hold us above this level here. Let me actually make that big. Okay. So we should be able to maintain price here. You may get a little bit of a push to the 20 SMA right over here. So we might get a move down into this area. So let's draw that out. So we have a level of support right there. That should be able to be an area that is held. Okay, and that should be a firm level of support. If it proves itself to be a firm level of support that can hold, then this should be the area in which we begin to see the market follow through to the upper projections on this upper time frame, up towards at least to the bottom of the ellipse, and depending on how things take shape from there, it may fill in the rest of the ellipse up to the pivot point and possibly up to the upper edge of the ellipse. Excuse me. See how much more interesting and more fun it is when you can go to these small time frames. There's a lot more action because you're obviously each bar is developing in seconds rather than in minutes. There's absolutely no difference between the Forex market, the stock market, the futures market, the commodities, okay? A symbol is a symbol is a symbol. It doesn't matter what the market is. All these things are based on principle. So if you think that this will work differently in the stock market or in the futures market or the that's the Forex, you've missed the points, okay? Don't fool yourself. When you're dealing with this is not a strategy. This is a principle in the market, that just is. Okay, it's like the laws of physics, the laws of gravity. Just is. Okay, it looks like we're holding here. We just created a little bit of a pullback and a rejection. We've got a reversal. This seems like it's holding. If it can close here strong, then that's a good level. If not, it may need to work through a bit more. But that looks like it's going to close.
And you're going to see the impact of any order flow with a much higher weight on the small time frames. So literally that shift in power that we saw could have just been one big market participant coming in and taking a rather sloppy entry to a bigger time frame position. Yeah,
that's a good point. And that's exactly what will often happen, because you're seeing that lack. The smaller the time frame, the less the liquidity. So you'll see these big bar bursts that on an upper time frame won't show up as much of anything at all. Just be a regular bar. They'll be in context, whereas in the small time frames it's out of context. So that's a great point. Okay, so it looks like we're moving up. We've got a strong hold here. It looks like here that we have a very strong 80% chance of moving higher. And we should be that bar there on the 243-second chart, depending on how that closes in about 3 minutes, a little over 3 minutes. If that bar can close on the 243-second, then we've established a firm level of support on the 243, which should then give us a much more decisive move to the upside that the market can follow through on with conviction. That's awesome, Jim. Currently in a head and shoulder trade in Forex. Already got my 1-to-1 and have trailed the stop to just below 1-to-1. So you've got no matter what, you've got a profitable trade. You've taken most of your risk off the table. Congratulations. Yeah, for those of you who, anybody else who is currently a client and is joining us, if you're trading. You're doing your own normal trading while you're watching us, let us know. Yeah, you weren't even planning to trade. Yeah, we weren't. Yeah, it's kind of unless you get a very clear, objective signal. Today's just a day that you probably wouldn't plan on trading. And rather than chancing another boring session for you, we wanted to kind of finish off our time together with something fun and active like this by being on the small time frames, just to kind of show you what you were experiencing in the longer time, in the bigger, deeper, longer time frames that seemed boring at times because of just because we have to wait so long between setups and all of that. You see here on the small time frames what was being done and how consistent it is and how reliable it is even on the small time frames. Yeah, for those of you who don't know, I spend probably easily now. Actually, lately it's been much more. I used to spend about 30 hours or so a week. Now it's almost 40 to 50 hours. I've taken over the task of. I've got a couple of elderly parents. I got a dad who's. He was in a situation where his cardiologist basically, let's just say, pressured him into taking medication he didn't need. The doctor just said, "Oh, because of your age, you should just take this as a preventative," which is amazing to me that we live in a world where we think that to prevent something we need a drug, as though your body's drug deficient. We need chemicals rather than nutrition. I won't go there because it'll just upset me. But he didn't need it, and the side effects of the medication in 90 days wiped out all of my dad's muscles. So he has severe muscle atrophy, and he's no longer able to really be independent and stand up and walk and do things on his own. And so and we're a very tight-knit family. We're there with him every day, all day long. He's at a nursing facility. So I have to, and thankfully, this is because of the lifestyle that this affords a person. I'm able to be there and support my parents. But what that does is it forces me, now I'm trying to run a business and develop something that can run with or without me. And so so I still have duties to be able to see that vision through. And so what happens is I have to push my own personal needs and my own business needs and everything else off to the ends, either early in the morning, late at night, or on the weekends. And so I'm constantly pushing my body to its limits physically. I'm just physically, it's just my evenings are oftentimes filled with just taking care of watching, making sure that I'm available for my mom and to make sure that she's okay. She's under a lot of stress and anxiety from her experience with watching her husband go through what he's going through. It's very upsetting to her, and sometimes that gets her to many nights where she's got high blood pressure and she's just from being stressed. So I constantly deal with that sort of thing, and so I end up living on 4 hours of sleep on a pretty regular basis. So I've pushed myself to the limits here, and I don't get a chance to take care of myself like I need to. This week I only had like one day where I could look after myself, and that was it, and that's just not enough. So my body seems to have hit a wall, and it's begging for me to get some rest. So we're trying to do it as best as I can. I had to recruit some friends to help me this week with my parents, so I could somewhat look after myself. I couldn't be there 100%, but anyway, so I apologize that you're having to deal with this throat and the coughing and on all that stuff, but we appreciate your understanding and patience. Hopefully you're enjoying and learning a lot and finding the value in being with us. Thank you, Sammy. Appreciate that. I hope so. So that support level didn't hold. I was busy talking to you. Let's look at this real quickly. You can see here that on our way up, if you look at this bar here to that bar there, there's not much of a difference, but this is disproportionate here. There's quite a bit of difference there, and so you saw that there's a lack of follow-through on that. So that didn't seem very sustainable, right? Same principles here at work. Now, that doesn't mean that the support level is going to fail completely to the point where we're going to come all the way crashing down. That may be the case, but we'll likely need to give a bit more room, a bit more buffer. So it may be that these areas here need to be tested. If that fails to hold, which would be the lower probability, it's possible, but it's less likely than these levels would have to be tested. Okay, so again, but this is, remember, in December or any time that you have a market that's really lacking liquidity, expect this type of failure, expect this type of jitteriness in the market, expect this type of widened zone of support and resistance that seems to be kind of loose and shaky and wobbly, and it's just kind of, you need to give it a bit more room. It's not as solid. These levels of support and resistance aren't as firm as they would normally be. So again, indicative of a tougher market because of the lack of participation. Okay, and again, not to mention, we are dealing with second time frames, right? So they're going to inherently be more noisy and less reliable. So you'll see higher levels of instability here. There's that shift again. So we're having another shift back. So look, there's a wobbliness here. It's just kind of stuck in a sideways range. When can we expect the markets to get back to normal? I wouldn't say that Monday the 5th would be a time in which the market will come back to normal. I'd say historically, as larger fund operations start to kind of come back and go back to work, they may go back to work, but I think there's a lot of data that they're going to be crunching from the holiday sales. So they're looking at retail sales reports. They're looking at all kinds of things. They're going to start to make their decision for 2015. So a lot of the big trading firms in Europe, I'd say about mid-January to first week of February is kind of the zone of when you start to see the market behave a bit more with a bit more normal behavior, more orderly price action, a bit more stability. I wouldn't. It may come in and into full swing, full gear, right in starting the 5th, but I would not count on it. Anything can happen, but you'll know really by how orderly your charts are when you get back and jump into the game. So, for instance, let's come back over here. You want to see order in the market. So when you see nice up and down, higher highs, higher lows, lower highs, lower lows, you see the moving averages, you're seeing levels of support and resistance respected. That's order. That's the market, basically coming in and not only creating levels of support and resistance, but respecting them, responding to them, following through on the inherent indicators that you're seeing in the market. Right? When you see a lot of erratic movements, when you see a lot of whipsaw bars, price bars that are out of character for no reason outside of scheduled news, things like that. There's no breaking news. That's a market that's lacking liquidity. It's shallow, not very orderly. So you'll see the behavior, and it's just like think of when you're out in the let's say at a sports event, and you're in line to grab some food. Well, if you're watching people, the normal thing that you should see around you is people partly watching the game, the sporting event, people waiting calmly for their turn in line, people talking. But if you see somebody that's kind of very quickly looking left, looking right, their eyes are kind of buzzed out, and they seem to kind of jitter, and they're looking nervous, and something's kind of up there, right? That person's looking a little bit off, right? Or you see two people beginning to raise their voice, and their hands are starting to move more erratically. So maybe a fight's about to break out, okay? And that can become a catalyst to if more people join in because the person's family member or friends, and it can turn into a mess and turn into a little bit of a riot. You're looking for things that are out of character, that are disorderly, right? That will be indicative of high risk environment, and so you want to stay away from that. So you're looking for these visual signs, and it's just no different in life. And again, you see how these are principles in life? And they apply the same way in the market as they do in life and anywhere, no matter what. So there's a consistency to the experience, whether it's erratic and volatile or orderly and calm and stable and slow and steady. You'll know where you're at and what you can expect. And in fact, you can even measure those things to the point that, for instance, when you see the market, let's see here. when you look at a market that moves from high to low, you could look at market geometry and anticipate basically from this low to that high. That's kind of the average rhythm of the market. Now that can happen slowly or that can happen kind of methodically. Okay, now it's been happening. If you come over here, bring that over here, here's the low, look at the high. It's within that range. Now watch what happens when you come over here. Look at the low, look at the high. Now these are much more, look at how these bars are way bigger, much more erratic, but the rhythm is about the same. But it's happening in shorter bursts, right, more quickly. So that's a bit more volatile. Look at here. Look at here. Okay. So and then that's where it changes and basically gets exhausted, shifts its weight, and starts to move back up. But you see how even when the market kind of the bars start to come look out of character to these smaller price bars. See how it's been small, slow, and steady, but the rhythm from high to low or low to high still is about the same here. So it's just a little bit of a shift in the way the market moves, how quickly it moves. All right. Does that answer your question, by the way? I hope that helps you guys out. I hope you understand what to look for, how to apply that. There we go. Cool.
You can really see, even if we include the pre-market back into the 4 or 5 a.m. time, the market really has done nothing today. We just have total overlap. We have a slight degradation in volatility. Volatility is constricting slightly, which could produce a breakout in the future, but really not a lot going on there. If you had been buying, as I said, back off those lows at 77, 78, you've been holding for several hours now without any real price appreciation or real damage. You haven't really been down much, you haven't really been up much. The market's just really in a very sleepy mode.
Sound familiar? That's exactly what we encountered last week, right? No fall through, set up and no fall through, and that's when we knew, okay, that's it. The market's pretty much done for the month. So there was no reason for us to trade today based on last week because we're doing the same exact thing. It was a day before the eve of a major holiday. Today is the day before the eve of another major holiday. So we've got New Year's Eve tomorrow. Last week it was Christmas Eve. We don't expect anything different, and that's exactly what happened. The market set up and didn't really go. It's still not. So we've got that target that we projected, but look at how it's not following through. But because we're on the smaller time frames, we were able to actually at least have some fun and get some activity and see some swings and some cycles up and down. But the actual intended target, now watch what happens if I make this, you know what, let me do it here.
Now, but let's be clear, if there had been a trade, we would have taken it. It's just that we're not expecting much, and
exactly.
And that's exactly what the observations have told us.
This is the 15-minute time frame now. Watch. Look at what that's been.
Nice power to the downside, potential continuation opportunity, and then all that power just digested almost instantly and never came back.
See that? So there's nothing there. So if we were looking at taking this trade north, right, to this projected zone, first of all, our risk reward wouldn't have been there anyway today. But let's pretend it was. Let's pretend let's pretend we're going to give it a little bit of a higher target. But if we came in here, okay, if that's our risk envelope, okay, well, actually it comes right in. Our one-to-ones just are up to the top of that. Okay, so which is that's a bit too aggressive anyway. But still, my point is this. So if we're on the 15-minute time frame, look at what happened. So this is very similar to last week, right? This is exactly what happened on Tuesday of last week. There was a setup, there was an entry, it was valid, but there was no follow-through, and it just was dead, going sideways. It was boring, not worth being in.
So if we had had a qualified entry and if we had taken that, there'd be no reason to stay in. We would have had a couple different times to get out and either take the small loss or take a small profit, as the case would be for that entry. You can see how easily it's telling you to do that. And the other thing that you really can't discount, although it doesn't seem all that obvious on the face of things, is look at how much time you have here to ease out of a position. So if you're trading much larger size, if you can't just buy and sell it at will because of the liquidity concerns of that, you had plenty of time to realize that you were in the wrong direction in the market, or the market wasn't conducive, and to ease yourself out without a lot of pain or suffering.
Yeah. So you take those things, you take all these variables into account, which help you, which help guide your actions. Really, your interests that then drive your actions, because the signals are clear, but they're always taking into account the context. Context is everything. Without context, you can't have the proper perspective.
All right, so I think we've kind of accomplished all of our goals at this point.
Yeah.
It's been a fairly successful, if slightly boring, December. Are there any questions anybody has out there? We appreciate you all being with us throughout this time, and especially as we're nearing the holiday again here with New Year's coming up. Any questions, any last interactions you'd like to have with us before we kind of wrap things up and put December on the books? Again, don't forget, too, the further the market goes down in the next day or two, the more we'll be outperforming compared to just pure benchmark returns.
Thank you, everybody. If you're not typing a question, or if you have a comment you'd like to make, if you have anything you'd like to say, you give us any feedback. We'd love your feedback. It's always encouraging to us, good or bad, by the way, because we are always constantly evolving as human beings. We're always learning, we're always refining and advancing, and looking at being a better version of ourselves. Hopefully you are too. That's kind of, if you're not growing and learning and maturing, you're dead, right? But if you're not typing a question or making a statement or anything, please type no, so we know that we don't want to wait, make everyone wait. We can wrap this up. We pretty much, as Bo said, have given you everything we had hoped and wanted you to experience, and the market's pretty much dead right now. You can see where it's going. So, all right, let's see here. Okay, you're welcome. Yeah, absolutely, welcome. Thank you. Sammy, check your email because we did reach out to you. I know we had a little bit of we missed each other there a couple of times. Yes, Happy New Year. Have a great New Year yourselves. Be on the lookout. We will be communicating to you here shortly with some cool information, some valuable things that will be coming along the way to you. Thank you. Yeah, we've got some year-end things we're gonna wrap up, and kind of the first year is gonna be a little bit busy for us. We are beginning to re-engage the institutional side. So 2015 will mark a shift in our focus as we begin to enter into a time where the group that we were nurturing and fostering and the track record we were building over the last 3+ years now, what we wanted to accomplish now has been mostly accomplished. We've got we're on the tail end of that process, and but ready to begin the next phase of our vision as we move forward and beginning to re-engage the institutional side with what we've established and built over the last 3+ years. So our focus is much more on that. So we'll be preparing some things here in the month of January in that regard, and towards those clients coming in with that interest. So be patient, but we will be reaching out to you here over the next, I don't know, week or two or so, give or take. And but we do have some neat and valuable things that we'll be sharing. So be on the lookout and reach out to us if there's anything we could do for you in the meantime. Let us know. And I want to wish everybody a very happy, productive, healthy, and peace-filled new year. On behalf of myself, for me, and behalf of Bo and Jared, we wish you the best, and we look forward to hearing about your successes in 2015 and helping you in any way that we can. Have a great one, and we'll see you in 2015. God bless everybody. Take care.